S&P 500 ends February with weekly, monthly declines. The Standard & Poor's 500 index experienced a turbulent February, shedding 1% over the last week alone, culminating in a 1.4% decrease for the entire month. This decline effectively erased much of the benchmark's gains from January, painting a mixed picture for investors as we progress through 2025. By the end of Friday's trading session, the S&P 500 settled at 5,954.50. Although the index is still up by 1.2% for the year, February's performance, with declines in 3 of the 4 weeks, highlights the unpredictable nature of the current market environment. Several factors contributed to this downturn. Notably, data released on Friday revealed an unexpected decline in consumer spending last month. This development is particularly alarming given that consumer spending is a critical driver of economic growth. Simultaneously, the Federal Reserve's favorite inflation metric showed signs of deceleration on an annual basis, adding another layer of complexity to the economic landscape. Investors are also grappling with concerns over the impacts of tariffs imposed or threatened by U.S. President Donald Trump. On Thursday, Trump announced that tariffs scheduled for March 4th would proceed as planned, including an additional 10% levy on Chinese goods. In response, China stated on Friday that it would counter any new tariffs imposed by the U.S., setting the stage for further trade tensions. Adding to these economic concerns, a tense exchange on Friday between Trump and Ukraine President Volodymyr Zelensky further fueled investor anxiety. The geopolitical uncertainty, coupled with ongoing trade disputes, has created a cautious atmosphere among market participants. In particular, the technology sector bore the brunt of the sell-off, experiencing the largest percentage drop of the week with a 4% decline. This was followed by a 2.6% decrease in communication services and a 2.1% drop in consumer discretionary stocks. The utilities sector also saw a downturn, compounding the week's challenges. Sector performance, the week's winners and losers. Within the technology sector, several stocks were particularly hard hit. NetApp, NTAP, experienced a significant 20% tumble after the company lowered its fiscal 2025 guidance. This move came despite reporting fiscal Q3 adjusted earnings per share that merely matched Wall Street's expectations, while revenue fell slightly short of forecasts. The company's outlook raised concerns about future growth prospects, contributing to the sharp decline in its stock price. In the communication services sector, Alphabet's GOOGL shares fell 5.2%. This decline was partly due to a complaint filed by Chegg, CHGG, against Google, alleging unfair competition. Chegg claimed that Google's AI Overviews feature has materially impacted its traffic and revenue, raising questions about the competitive landscape within the sector. Despite these challenges, there were some bright spots in the market. The financial sector emerged as a notable winner, rising 2.8% for the week. This was followed by a 2.1% gain in real estate and a 1.7% increase in healthcare. Other sectors, including consumer staples, industrials, materials, and energy, also managed to edge higher. Erie Indemnity, Erie, stood out within the financial sector, achieving the largest percentage increase with a 12% rise. The company's strong performance was attributed to year-over-year gains in Q4 earnings per share and revenue, signaling robust growth and resilience in challenging times. Looking ahead, upcoming reports and economic indicators. Looking ahead, investors are bracing for another eventful week as several major companies are set to release their quarterly results. Among the companies in focus are Broadcom, AVGO, Costco Wholesale, Cost, and CrowdStrike Holdings, CRWD. These earnings reports will provide valuable insights into the performance of key sectors and offer guidance on future prospects. Investors will be keenly watching for any indications of how these companies are navigating the current economic challenges and adapting to evolving market conditions. In addition to corporate earnings, economic data will play a crucial role in shaping market sentiment next week. Investors will be particularly focused on February's jobs numbers. On Wednesday, ADP's employment report will offer a snapshot of private sector job growth, while the government's non-farm payrolls and unemployment rate, due on Friday, will provide a more comprehensive view of the labor market. These reports will be closely scrutinized for any signs of strength or weakness in the job market, as employment trends are a critical indicator of economic health. As investors digest these upcoming reports and economic indicators, they will also be assessing the broader implications for monetary policy and interest rates. The Federal Reserve's stance on interest rates will be influenced by economic data, and any shifts in policy could have significant ramifications for the market. With inflation concerns still looming, the Fed's approach to managing economic growth and price stability will be a key area of focus for investors. Frequently asked questions. How did the technology sector perform this week? The technology sector experienced the largest percentage drop of the week, falling 4%. This decline was driven by a combination of factors, including disappointing earnings reports and broader market concerns about economic uncertainty and trade tensions. Which companies saw the largest increase in the financial sector? Erie Indemnity, Erie, saw the largest increase in the financial sector, climbing 12%. The company's strong performance was attributed to year-over-year gains in Q4 earnings per share and revenue, which bolstered investor confidence and contributed to the stock's rise. What economic data will investors focus on next week? Investors will focus on February jobs numbers, including ADP's employment report and the government's non-farm payrolls and unemployment rate. These reports will provide critical insights into the state of the labor market and will be closely watched for any indications of economic strength or weakness. As the market navigates this complex landscape, investors will need to remain vigilant and adaptable. The interplay between economic data, corporate earnings, and geopolitical developments will continue to shape market dynamics and influence investment strategies. While challenges persist, opportunities for growth and resilience remain, underscoring the importance of careful analysis and strategic decision-making in an ever-evolving market environment.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.